When we talk about problems with the internal rate of return, there are some methods to take into account when we get two rates within an internal rate of return calculation because of inconsistent cash flows. So when we do that, it's called the modified internal rate of return, or MIRR. There are three different methods for calculating this. The first method is the discount approach. This is where we discount all future values to the present and add to the the year zero cash flows. The second method is the reinvestment approach. In this approach, we compound all cash flows except the first one forward to the end of the project. And then the third method is a combination approach where we do a combination of both. One is we discount the outflows to the present, and then we compound the inflows to the end. Any method that you choose, the entire purpose of the method is to get rid of the second cash outflow so that you can calculate the internal rate of return without getting two different numbers. Under each one of these methods, you will have a different internal rate of return. The discount rate that you use or the compounded reinvestment rate would be supplied, and it would be based on the company's required rate of return on investment projects. So we're going to look at example using each one of these methods individually. So for our first method, this is the discounted method. So we have in year two, we have the negative cash flow of $100. We discount that back to year zero or investment year and add them together. That way, we only have one negative value in our series of cash flows. In the second method, this is our reinvestment approach. We compound all cash flows except cash flow zero to the end of the project's life. This zeroes out all cash flows which have been added to the last year of the project's life. And we compute the internal rate of return normally under that method. Then we only have one negative. So we're looking at the future value amount for the year one cash flow, adding it to the year two cash flow. In the third method, we do a combination of both. So we discount the outflows to present and add them to year zero, and then we compound all inflows to the end of the project. Then we compute the internal rate of return normally. For doing that in Excel, the discount rate is the rate which causes the present value of a project's terminal value to equal the present value of costs or outflows. MIRR assumes all of the cash flows are reinvested at the company's WACC, weighted average cost of capital. So you can use the MIRR function using the range of your cash flows, the finance rate, which is the discount, and the reinvestment rate, which is the compounded reinvestment rate. Excel, when it calculates it, does method 3. If we're looking at using mathematical formulas, or we have this timeline here where we have a 20% required rate of return, we look for the future value of inflows. I like that there's a typo in this slide. The future value of the inflows and the present value of the outflows. We then do the present value equals the future value divided by 1 plus the internal rate of return to the power of 2, because it's a 2-year project, gives us a modified internal rate of return of 19.87%. This slide shows you how to input it into the calculator, into a financial calculator or a scientific calculator. So first we have our mathematical formula, then we have the calculator inputs, and the Excel inputs. Now, the modified internal rate of return assumes that the reinvestment is at our opportunity cost or our weighted average cost of capital, where the internal rate of return makes the assumption that we are reinvesting at the internal rate of return, which is not always the true information about a company's cash flows reinvestment. Modified internal rate of return also avoids the multiple internal rate of return problem when we have more than one negative cash flow in a series of cash flows. Managers like rate of return comparisons, and for those comparisons, the modified internal rate of return is better than the internal rate of return calculations. Another way that we can look at capital projects is by using the profitability index. The profitability index measures the benefit per unit cost based on our time value of money. When we're using the profitability index, we're doing that because we're trying to rank capital budgeting projects in order to make a decision about them, especially when we have limited funds available, or as the textbook talks about, in capital rationing. In situations of capital rationing, this is where a company only has so much money each year to spend on capital investments. And so they can't take on every project that is available to them, and they can only take on certain projects. The decision rule for the profitability index is if the profitability index is greater than 1, we should accept the project. Now, we can also pair this with our other decision rule of net profit value, because if the profitability index is greater than 1, the net present value is positive. If it's less than 1, the net present value is negative. For conventional cash flow projects, we have the present value of cash inflows divided by the absolute value of the initial investment. Advantages and disadvantages of the profitability index. One of the advantages is that it's closely related to net present value, which is the most preferred method for making decisions about capital projects. Generally leads to the same exact decision as the net present value. It considers all cash flows, it considers the time value of money, and it's useful in capital rationing. It's easy to understand and communicate to others. It's easy to calculate. Disadvantages is it might lead to incorrect decisions if we're comparing mutually exclusive investments. So when comparing mutually exclusive investments, then net present value should be the deciding factor and no other factor. And we can see this example here where we have the present value of cash flows and the initial investment, giving us two different profitability indexes, where the highest profitability index has the lowest net present value from the two projects. In this case, you would side with the net present value. Capital budgeting in practice, we should really look at all investment criteria when making decisions. It's not a good idea to just select one method and use that for all of your decision making. There are multiple methods, and using them as a whole to get an idea about the capital budgeting decisions. Net present value and internal rate of return are the most commonly used for the primary investment criteria, followed by payback method as secondary investment criteria. They all provide valuable information. Remember, the main complaint about the payback method is that it doesn't follow time value of money. And in that case, you can use a discounted payback method, which discounts all of the cash flows down back to the present value, and then it does follow the time value of money. And that is the end of chapter 8.